Reporting season's been really tough. It's a reflection of what's been going on in the environment. So from a surprise point of view, results have been tough, maybe showing things to be a little bit tougher than the market was expecting. And we're seeing that in terms of share price reaction as well. So share prices are down. Market was anticipating things to be tough, but the price reactions probably indicate that results on aggregate a little bit more disappointing than expected. Standouts from a negative side of things, Spark continues to disappoint the market, fourth downgrade in a row. Share price has been expectedly hammered on the back of that, down more than 20% over the month. Ryman share price, as you would expect, down a lot on the back of the capital raise. And then the likes of Heartland Group as well, taking a $50 million impairment across some of its loans, mainly in the motor finance and business lending. Quite a surprise to the market and impacted heavily on the back of that. The other end of the spectrum, we've had A2 provide a positive surprise for the market. So 6 months ago they disappointed the market with some talk about revenue growth and margins, and they've come through with this result with a much better outcome than the market was expecting. So revenue starting to grow, margins expanding, and the stock price up around 40% over the month. The key thing for us, and a real positive, is that they're maintaining their dividend guidance outlook for this year, so at least 21 cents a share, and also still maintaining their guidance for next year of at least 30 cents per share, which makes it a very attractive yield. One of the big things for Sky TV in the near term, outside the satellite migration, is the rugby rights. So all eyes are on those. Do they renew those rights, and if they do renew those rights, at what price that those rights come at? The difference between how Somerset is going and how Ryman is going, I think, reflects some of the changes within Ryman. So the organisational restructuring, the changes to its pricing model, really impacting on the short term. They're talking about pick up in some of their interests within their units, but that will take time to flow through, and the near term has been impacted by what's been going on within their business and changes to its pricing model. I don't think reporting season's made any sort of changes to how corporate raiders or takeovers and mergers might occur during the year. It was something that I thought about late last year about prospect for this year occurring. Nothing's changed from reporting season that would influence that. But certainly with interest rates being lower, so the cost of capital lower, if somebody was looking at a company, it's certainly cheaper to fund a takeover now than it was 6-12 months ago. On the trade war side of things, tariffs from the US and retaliation from other countries, no direct impact or no material direct impact on New Zealand outside of the likes of Fisher & Paykel Healthcare, which has manufacturing in Mexico and sends product across the border into the US. But that's the key one from a listed point of view. But the broader economy, maybe some of the agricultural stocks or sector that sell product into the US might be impacted, so a broader economic impact for New Zealand. And then just general market sentiment as well. So we get the US share market sell off, and New Zealand tends to go down on the back of it, certainly in the short term, on a sentiment view rather than any material change to earnings. From here, as investors, we're starting to focus on the next reporting season, so 6 months from here. Either the companies that have just reported their full year results or half year results for some. What are they starting to see? What do those results look like? Are we starting to see a recovery in earnings from the economy picking up, or are things still a little bit stagnant? But also, again, focusing on those outlook statements. So do they see green shoots in 6 months?